Hey everyone, welcome back to Cash Flow Confidence. I'm Shelby Ashley, and I help business owners feel more confident about their cash flow. So continuing the conversation on, I made a lot of money, but where the heck is it? The last episode was Where Your Profits Are Hiding, Part 1, and today I'm going to talk about Part 2. So last time we looked at the things beyond your profit and loss as to where your cash is going. So your profit and loss shows revenue and all of your expenses, and then it shows your net profit, but your net profit does not equal what is in the bank account. And so I'm trying to kind of marry that up for you guys so you understand where the disparity is between your profit and what's actually in the bank. Last time I talked about accounts receivable and accounts payable, and I talked about the importance of making sure that your customers owe you, like they owe the invoices that you've invoiced them before you owe your suppliers. You don't want to be in a situation where you owe your suppliers in the next 10 days, but your customers don't owe you for the next 30 days. In that situation, you're basically acting as a bank, and you don't want to do that. So beyond your accounts payable and accounts receivable balances, the next area where your cash can get tied up beyond your profit and loss is any equipment and asset purchases. So if you buy a trailer or a truck or a bunch of office furniture, whatever it is, it's not going to show up on your profit and loss because it's going to show up on your balance sheet under fixed assets. The reason is because you're not only using these things for like a specific period. Like your profit and loss is going to show per month or per year. You're going to be using these equipment and office furniture purchases way longer than that. And so it wouldn't be fair to have them all show up, all that cash outflow show up on one profit and loss, because it's going to really skew your business's performance. And so you're not going to find any asset purchases on your profit and loss. And so let's say you had a great month or a great quarter or a great year. You turned a huge profit, but you bought 2 trucks for 2 of your technicians. You're going to show all this profit, but your bank account is obviously going to be really low because you bought 2 pretty big things. And so that's cash out the door. That's not going to show up on your profit and loss. And so you need to keep that in mind when you still need that cash to make payroll or cover maybe like a slow sales month, pay your own salary. So keep that in mind when it comes to big asset purchases and utilize debt for that where it makes sense. We're going to get more into debt in a second, but when it comes to big asset purchases, it's not always wise if you have the cash to pay cash for big assets because you're going to need that cash to continue operating the business. So in situations like that, it makes sense to take out a loan or use your line of credit or whatever debt you may have at your disposal. So that leads me to my next section, which is debt. Debt is a place where cash can show up in your bank account even when it doesn't show up on your profit and loss, or on the contrary, money can show up on your profit and loss and your bank account looks pretty low because any debt payments aside from the interest is not going to show up on your profit and loss. If you take out a new loan, that huge cash influx is not going to be treated as revenue. You're not going to see it on the profit and loss. It's only going to show up in your bank account. The interest portion, when you start to make payments on that debt, that does show up on your profit and loss, but the actual principal debt payment does not show up on the profit and loss. I had a client previously who got in a really bad spot before he started working with me because he was in a place where cash inflow was really, really good. He was really up for the year and had a lot of net profit. So his accountant told him, and this is terrible advice, that because his profits are so high, he is obviously going to pay a lot more in taxes. They said, throw that money towards your debt that's outstanding, and that'll lower your tax bill. So here's what happened. His profits didn't go down whatsoever because debt repayments do not lower your profits. And all he did was throw cash at this debt only to turn around and owe the IRS a ton of money because he still had to pay taxes on those profits. Okay, so debt repayments do not show up on the profit and loss. They do not. They only show up on your bank account. The final area of cash versus net profit that I want to talk about is your owner distributions. And I'm not just talking about your salary, like your actual wage. I'm talking about any bank transfers you've made, any personal purchases that you have made using a business card. Those show up as owner distributions. And so when you're looking at a profit and loss and it's got all this profit, and yet you look at your bank account and you don't see any money in there, it could be because you literally just took it from the business as an owner distribution. And I mean, you as the owner, you're entitled to take distributions from the profits that you earned. Nobody frowns on owner distributions. It's just something that you have to keep a close eye on because, times when you're like, oh, I'll just transfer $2,500 to cover this vacation coming up, or, oh, I can't find my personal credit card, so I'm just going to use the business credit card to pay for this meal. Things like that, they start to add up before you can, kind of realize it. And like I said, they don't show up on the profit and loss. And so you're seeing all this profit, and meanwhile, your bank account's just getting lower and lower and lower. So it's very, very important to establish some kind of rhythm when it comes to taking money from the business. Now, of course, you're going to have your actual owner's salary that will just run through payroll. But when it comes to actual taking money from the business, have a plan. Is that going to be, well, every quarter I'm going to take X amount of money, or once a year around Christmas, I'm going to take out so much money, or once a month, I'm going to transfer this much. I always say to my clients, because they always ask me, I've got my wage, but how much should I be actually taking out of the business? Leave yourself enough cash in the bank, in the business checking account, to cover 3 or 4 months of business expenses. The more, the better, obviously. If you can take a distribution and then still have that cash reserve in the bank, in the business, that's awesome, because now your business is in a healthy spot. Come what may, if you don't make another sale for the next 2 months, you've still got cash in the bank. And then also, you're taking a portion of the profits that you have earned. And then I have clients on the other end where they are only paying themselves a salary and they're not taking any distributions. And I always warn against this, because you can start to get resentful from your business really fast if you're paying yourself a lower than marketable wage. Meaning, if you were doing that job working for somebody else, they would be paying you a lot more than what you're paying yourself. Don't do that to yourself. But if all you're doing is just taking a salary and you're never taking a distribution, you're going to grow to resent your business really fast, because the whole reason you started your business was to own something and to achieve financial freedom, right? So find that sweet spot of how much money can I, as the owner, that I have earned and am, supposed to take out. How much can I take out and also leave in the business so that the business is still healthy and I'm not sacrificing anything? So just to recap this episode and last week's episode, I talked about all the places where you're not going to see your cash going on the profit and loss. And that was accounts receivable, your clients taking too long to pay you, accounts payable, you having to pay bills a lot sooner than you should. We talked about on this episode debt repayments, owner distributions. We talked about big equipment purchases. There's one other area where cash kind of gets tied up. I'm not going to go into it because it's hard to talk about it without sounding like an accountant, and it's going to get real confusing. It confuses me even, and that's inventory, specifically days inventory outstanding. I'm not going to get into that though, because it's very, very much in the accounting weeds and just not fun to listen to whatsoever. So most of my clients anyway don't carry inventory, but they all have these things that affect cash flow. And so your profit and loss tells you what your business earned, but your cash flow tells you what you actually kept. And so the moment you start tracking these things, whether it's on a simple spreadsheet or even a whiteboard, you start to go from where did all the money go to I know exactly what happened and what's coming next. And that was, kind of my purpose behind doing this short little series. And so if you would like to know, okay, well, Shelby, how much money can I actually take out without, absolutely annihilating my business? That's what I'm here to do. So definitely reach out to me and we can put a forecast together for you to show you what you can be paying yourself and how you can actually keep the business healthy and growing. Until next time, I'll see you guys next week.